Should you trust this rally? Economic data continues to worsen. We're going to talk about that on today's stock market brief. We got macro to talk about. We're going to get into the charts and what to watch out for the remaining of this week. Let's get into it. Whoa. Welcome back, everybody. We're looking at the United States Red Book Index. For those that are unfamiliar with this is tracking weekly retail sales. Excuse me. We had a pretty significant slowdown, 5.3%. This is a weekly report. It came in at 5.3% year over year, and this compares to the prior week being 10.2% year over year. So a big drop off there. Now, if you take a look though at the XRT Spiders ETF, this is a retail ETF, it was up 2.34% on the day, albeit it was on some pretty insignificant volume, very low volume on this run up, which is a little disconcerting. Now, also we got some macro data here as well. United States NFIB Business Optimism Index. So this came in at 89.8, and the previous was 91.9. This is marking the 12th straight month below the 49-year average. Expectations for better business conditions over the next 6 months worsened by 8 points to minus 51%. So the economic data, to say the least, is not getting better as it stands. However, we're seeing a rally. And this rally, should we trust it? Well, I wanted to show you something quite interesting today. If I pulled up FinViz Scanner and I look at short floats, okay, and we're looking over 10%. So I want to see, hey, are these stocks really performing right now? And I just up the volume to look at the strongest volume first and look what pops up, like things like Bed Bath & Beyond, SoFi, MARA, right? CCL, all these probably very familiar names that you're well aware of if you're in this industry that have a high float short rate of over 10%. Now, this is where it gets interesting. Take a look over here at their performance. Interesting. So a lot of the high short interest stocks were up on the day, but how many? Well, let's go to the next page. Oh, what do you know? They were pretty much all up on the day, minus a few. Go to the next page. Oh, what do you know? They're all up significantly on the day as well. So I wanted to look, okay, well, how many actually were up today? So we pulled up performance today up, float short over 10, 21 pages. Well, actually, technically 20. There was only one on this last page. So 20 pages of these stocks that were up. So a total of right here, 401. Okay, now I said, okay, well, how many of them were down? Well, out of all of those with the same scan, but just looking at the ones that were down, there was only 5 pages. So this could be very well the reason why we're starting to see small caps outperform. And this isn't the start of it. We've actually seen them outperform on a relative basis too. So yeah, something to be interested in or something to pay close attention to, because a lot of time these short squeeze rallies only last to a certain extent, and then all of a sudden things start to fall apart again. This is what we've seen on prior bear market rallies as well. So what else do we got going on for the remainder of the week? All eyes are going to be on that inflation report. We had the Jerome Powell come out today. We didn't really talk about monetary policy or anything, and the market just kind of threw that to the side and just did a chop day and then closed at the high with some weak volume, which tells me, hey, yeah, the market's kind of just prepping and waiting for this, more macro data to come out. Now, the inflation rate consensus is coming in at a fairly lower read, a pretty significant drop off to 6.5%. Okay, so that's the inflation rate year over year. The previous was 7.1. So if we go to the nowcast, I think this Cleveland Fed nowcast, we'll see how reliable this is. 6.64% is their nowcast model. So that would come in higher than consensus, which the market would perceive that potentially as bad. But to take it to another level, we can look at JPM Morgan's game plan on CPI day. We'll see how, what this is, but the probability of reaching a 6.4 to 6.66% is 65%. That's according to their data, which means potentially the S&P 500 to them, they're looking at up 1.5 to 2% on the day. So even if inflation comes in at 6.66%, which is above consensus, JPM is saying, hey, we still may see a 1.5% to 2% up day. Now, if it's above 6.6%, there's a 15% probability. We're looking at down 2.5 to 3%, which is a significant move to the downside if that were to actually take place. The last one is a 20% probability below 6.4%. So if it does come in below consensus, if it comes in at 6.4 or below that, they're looking at a potential 3% to 3.5% rally. Absolutely crazy. Now, if we continue on, we do have some earnings to be aware of. That's after CPI day, which is on Thursday. After that, we're following up with a bunch of financial earnings, some of which are the likes of Bank of America, JP Morgan, Wells Fargo, Citi, BlackRock, okay? And then a couple others. Now, we also have United Health Group. One to watch coming into tomorrow's close, after the close, is KBH, I believe, is the ticker symbol for that. This is KB Homes, rate sensitive, and I'll show you why. If I pull ITB up, now ITB's KHB is not one of the top holdings. It's about 1.1% weighting. If I look at the top holdings for the ITB, you're looking at DR Horton, Lennar, and these have all been performing quite well. As you can see, ITB ETF has been going up. So does this mean, hey, yeah, let's buy and we're in the clear? Well, I mean, it is pulling from a technical standpoint, blah, 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 blah. It's pulling into prior resistance areas, prior resistance, prior supply. If it breaks above it, it might see a potential pop higher. Always a possibility. So if we take a look here at ITB up here at the top and the 10-year yield, we'll just use TNX at the bottom. I can show you why. Why have they been performing poorly up until recently? Well, you can see here the 10-year yield has been on a pretty nice move to the upside from the prior year. And you can see here the ITB ETF has been getting hit hard. And when we had a sharp spike, that really affected home builders right there. But then all of a sudden, the 10-year yield started heading down. And what happened? Well, we start to see a pop up there in the ITB. Oh, what happened when we started spiking again? It put pressure back on it. And up until recently, you can see the 10-year yield's been backing off slightly, and then we have ITB that has been progressing to the upside. So if the 10-year yield potentially spikes and these rate-sensitive names get hit, watch out, because ITB, right, might not be one to watch or to be looking to go long at this particular time. Now, if the 10-year yield starts to fall, that could be a potential positive sign where we start breaking out of that base. Something to think and consider moving forward. Now, let's go ahead and actually hop into the S&P 500 and see what we got going on overall. Today, we had a nice recovery type day that's following through. Yesterday's video, we said, hey, the bulls are still in control. Well, sure enough, they showed up today. However, I want to just remind you that it is on light volume, which could tell me that they're really waiting for that CPI report as price kind of just doodled around and chopped. We have that open gap above us, but remember, we still have a large area of resistance right above us too as well, with the trend line, the 200-day moving average, and this gap slightly right there too as well. We have, from a bullish perspective, that MACD curling itself back up. Take a look at the 15-minute chart. We are above that 5-day moving average, and it is inclining. We were looking for a pullback today. We got it. I wish it went a little bit deeper for a more concise buy. I like to do what's called buy on the U-turn, or U-turn strategy, where price comes down through these key levels, and then all of a sudden it kind of shakes people out. Then all of a sudden we start to get price momentum back up to the upside, which would have been nice, but it didn't quite happen. Overall, it was a choppy session. Myself, I didn't trade. If we take a look here, you can see that during the day we had that low, we had another low, and we had another low. So what is that? What is that telling us? Well, we have a low, a higher low, and a higher low. It means the bulls are progressing forward. And you can see here at that last closing candle, we popped above the week-to-date anchored VWAP, which is this one right here. And then we also popped right back above the December anchored VWAP. So as it stands now, we're above the year-to-date. December's, we're above week-to-date. And we're above the 5-day moving average. So as it stands currently, the bulls remain in control on the shorter term trends. Going into the CPI report, I want you to be aware that, hey, so tomorrow we're only looking at about a plus or minus $3 move in the SPY, okay? If we take one day out, look at how it pops to 35% vol. This is looking at almost an $8 move plus or minus. So the volatility, it's telling us, hey, traders are waiting for that report. That's where the volatility is going to be coming on Thursday. Even if you look at the weekend, you're looking at an $8.6 expected move, a 30% vol. So you can see there that the big data or the big moves look like it could potentially happen Thursday. I would not rule out that these levels can't get hit prior, but just be aware that Thursday is packing some heat. Now, if we go on and we take a look at the Qs, I just wanted to call out this little trend line right here, and then we kind of just have this, just the bears kind of just knocking at this door right over here, and we're starting to bounce a little bit. Still below that 50-day, still below a declining 5-day moving average. We had that MACD curl up. We have a horrible relative strength overall, so we're getting a little bit of a bounce, right? And we talked about this on some various other indicators I don't want to get into on this episode. But let's take a look here at the 15-minute time frame and take a look at that expected move at about 277.54. We got above that week-to-date anchored VWAP, which is a positive sign. We're above year-to-date. We're above that 5-day moving average. But over here, we have the December anchored VWAP, which is in line with this prior swing high. So 275, slightly above. As time progresses and this moves up, this might be pulling down a little bit, which could act as a level of resistance to be aware of. Other people would call that a possibility for a double top. Just because it touches here and touches here doesn't quite make it a double top. You would actually want to see it cross down through that low, and then you can consider that a double top, which could open the door for even more volatility down there to the downside. So yes, we got that pullback to the downside, and then all of a sudden we got that squeeze higher. Just a bunch of chop overall today. Now, taking a look at volatility, you can see here tomorrow is a $2.8 expected move, but the action is packed on Thursday, where it jumps up to plus or minus $7 move there, and then at the end of the week a plus or minus 7.6. So you can see just how important that macro data report is going to be, and as we've seen throughout these months, how important and reliant the market is on that data. All right, the last thing I want to close off with here is the zones. Now, the reason why I share this is because it gives a good idea as far as where is the risk relative to the reward. And you can think of it as a Bollinger Band, but it is different. It uses Benoit Mandelbrot's bridge range as well as a Hurst component, originally created by Joe Catanzara. And all I do is extract data from a larger perspective to get a really good idea as what things are overextended and what things are overbought and potentially oversold. So if you look at the zones and you see low, the mid, high, well, all you would have to do really is just think of it like this. You have a high point of the zone, you have a low point of the zone, and then you have a midpoint of the zone. And then we'll take the SPX, for example. You can see it closed at 39.20, okay? And it's telling us in this zone, it has about 0.5% upside to about 3.23% downside. And it shows the range is saying, hey, yeah, it's getting red, it's hot, right? It means it's at the upper portion of its range. So if I were to draw those back, I keep on doing that, high, low, mid, where would the S&P 500 price be within these zones? Well, it would be roughly right at about here. Okay, so it's saying it's at the very higher end area of the zone. So it has, like I said, potential downside versus potential upside. Now, that means basically, hey, we can, and by the way, price always fluctuates back and forth to the high end area. Now, it might not always reach it. It might come down within 20, 30% of it and then come up to 20, 30% of it. It might stay there. It might press it higher. These are dynamic, right? They're changing. But just be aware that, hey, when it's all red like this, it's telling us S&P 500 is at the higher end. The VIX is at the lower end. Oh, volatility is low, S&P 500 high. Go figure. The dollar is at the lower area too, which means it's down here. Oh, and we know about those negative correlations. If the dollar bounces, it could put pressure on various assets. Oh, gold is up there. Oh, okay, there's silver. Silver's not really, silver came off a little bit today. Look at Bitcoin getting pretty darn frothy. Potential 6% downside to, it's actually technically outside of its zone. It's at 17,545, so it's playing outside of that, which is always a possibility too, but it's never gets too far from that point. It usually comes back within. And you can see the Qs are getting up there, the IWM. So the downside is growing while the upside is shrinking. Okay, so that's what that shows me on a quick standpoint, and it lets me know, hey, as we're coming into a CPI report, this could get downright ugly fast. Now, these are dynamic. Once again, these aren't there is no such thing as a holy grail, unless if you're reading the Street Smarts book, which was a YouTube short that I posted about the holy grail trading strategy. But this is just to give you an idea like, hey, maybe I should probably not go long at this particular point in time up here. Maybe I should take some profits. And then when it comes back to the lower end, maybe I can potentially look to scale in, as long as whatever you determine for a trend is still up to go long, or if the trend is to go down, you'd rather short at the upper ranges there. But as I could state and see right here, things are getting pretty red hot. Macroeconomic data still coming in not all too well, as we're already pointing out. We have a lot of red cards coming up for the remainder of the week, including inflation and including the earnings as well. So we got an action-packed week ahead, everybody. I want you to be careful, be safe. As it stands on the shorter time frames, we're still looking decent, but things can change, and things can change quick in this market. That's all I got for you.